What's going on, guys? Crypto Renegade here, and in today's video I'm going to be talking about President Biden, taxes, and crypto. Not really the most favorite topic when it comes to crypto enthusiasts, but what can we do? Many people don't know this, but tax evasion through crypto winnings or holdings and transactions has become a problem. Well, not a big problem so far, but it can exacerbate if it's not kept under control by them. And for those of you who do know, yes, we are going to discuss the IRS and what has been happening lately regarding taxing crypto. But before I jump into the content, I just updated my new free ebook on the 7 best ways to secure your crypto, updated for 2021. It's 100% free, so check that out in the description, and it will also be pinned in the comments. All right, let's get started. So logically, there is one way that winnings through crypto can be taxed, similar to the stock market. The IRS can tax crypto winnings as capital gains. Cryptocurrencies are considered assets and/or property. If you hold an asset for less than 1 year, your crypto gains will be taxed as a short-term capital gain at the same rate as your ordinary income, with a range of 10% to 37%. If you hold an asset for more than 1 year, it will be taxed with the long-term capital gains tax rate, with a range of 0 to 20%. However, this is not all regulated and placed in the most correct way as possible. Since there are a lot of new things coming up with this new technology, the government has yet to figure out the best way to try and steal your money via taxes through crypto winnings.
It's never too early to learn that the government is a greedy piglet that suckles on a taxpayer's teat until they have sore, chapped nipples.
Another, let's say, problem with crypto is the fact that you are almost totally anonymous. This is one of the greatest perks that people like about crypto. But when it comes to the government and the IRS, this can be a tax reporting nightmare. Can the government completely control the decentralized system of cryptocurrencies? What can we actually expect regarding taxes in the future? And how will they work? We are going to try to answer all these questions and more in this video. So here we start with President Joe Biden's 2022 budget proposal. Ever since Biden became president of the United States, he did not forget about cryptocurrencies. That is why in his budget proposal, he included several new crypto reporting requirements. According to a pair of documents published Friday, the budget that was published, the first from the Biden administration, includes 2 different proposals. These proposals would give the Treasury Department additional requirements around what type of information financial institutions must report to the Internal Revenue Service, or IRS, or other Treasury sub-departments. What exactly does that mean? More information means more clarity for the government, thus more requirements and more red tape.
I will walk deeper into the belly of the beast if it means I'm able to further limit reckless government spending. I mean, I have so many ideas.
This way, the IRS and other Treasury sub-departments can decide on how they would further tax cryptocurrencies. Let's start with the first proposal. In the first proposal, we see mentioned the White House budget itself, asking for brokers to expand the information that they are reporting regarding crypto assets. Not gonna happen in my opinion. So basically, crypto brokers have to provide the IRS and other federal departments with more data. What does that mean on paper? A Treasury Department Green Book provided more context on this specific matter. They said that the proposed change would expand the scope of information reporting by brokers. So this will allow the brokers, for instance Binance or Coinbase, to share information across different jurisdictions that have partnered with the US. Here is what the document states. The proposal would require brokers, including entities such as US crypto asset exchanges and hosted wallet providers, to report information relating to certain passive entities and their substantial foreign owners when reporting with respect to crypto assets held by those entities in an account with the broker. So gross proceeds, sales, and substantial foreign owners in passive entities would be concluded in these reports. Now, guys, this basically means that any gross transactions, including sale of crypto and more, and other foreign crypto holders in other brokers or exchanges will have to report further information to the IRS respective to their jurisdiction. This proposal, if approved, will take effect for returns filed after December 31st, 2022, according to this document. This is what the Treasury Department document said as an explanation for the proposal. Tax evasion using crypto assets is a rapidly growing problem. Since the industry is entirely digital, taxpayers can transact offshore crypto with those exchanges as well and wallet providers without leaving the United States. Close quote.
You just think the government's just batting 1,000 and telling us the whole truth?
Now let's dive a little deeper into the information reporting part of this. The 2022 budget includes several other crypto reporting requirements. According to the Treasury document, enter the second proposal. This second proposal wants to introduce a comprehensive financial account reporting structure for tax compliance purposes. This would require institutions to report data on user accounts with a breakdown on different types of transfers above a minimum threshold of $600. This would include crypto asset exchanges and custodians like Coinbase or Binance, the document said. Let's take a look at what the proposal said. Quote, separately reporting requirements would apply in cases in which taxpayers buy crypto assets from one broker and then transfer those specific assets to another broker, and businesses that receive crypto assets in transactions with a fair market value of more than $10,000 would have to report such transactions. Get the point here? So they want us, the public, to report any transactions involving buying crypto or transferring them from one broker or exchange to another, or even your own personal wallet or hardware wallet. They want businesses to report any crypto they receive for transactions of more than $10,000. Think about this for a second. You go now on Binance or Coinbase or whatever the case may be, and you decide to buy $10,000 worth of Dogecoin, for example. Do you have to report anything right now? Or is it you just keep your Doge and keep it in your wallet and wait until it hits $1 to sell it? What are these guys trying to do here? Control us? Starting to smell like fish again. And this time, it's not the good kind of fish smell.
God's way of determining who is smart and who is poor. Crying, acceptable at funerals and the Grand Canyon. Rage, poise, property rights. Fish, for sport only, not for meat. Fish meat is practically a vegetable.
The rich one can only come from the federal government, but I digress. The budget comes just over a week after the Treasury Department proposed that financial institutions and other businesses which receive transfers of over $10,000 in crypto report those to the IRS. The proposal is similar to a Financial Crimes Enforcement Network proposal as well, or Fincen. The requirement is on par with transfers of $10,000 or more in US dollars. The Treasury report highlighted virtual currencies and cash as potential ways to hide income from the government. Quote, despite constituting a relatively small portion of business income today, cryptocurrency transactions are likely to rise in importance in the next decade, especially in the presence of a broad-based financial account reporting regime. Close quote. This move comes at a time in which US regulators are tracking the movement of cryptocurrencies more closely via the blockchain. Now that cryptos have become a huge matter and coming straight for the fiat currency's head, now they want to control it and tax it into oblivion. In a way, obviously, that benefits them and not us. If I recall it right, back in November, the Financial Crimes Enforcement Network, or Fincen, proposed lowering the threshold at which banks must collect and store fund transferred information. So they wanted to reduce the threshold from $3,000 to $250 for any transfers. No matter if the transfers were crypto or fiat, if that crypto went outside the US, boom, the bank would need to report it. Now, isn't that convenient? Also, do not forget, back in December, Fincen proposed a rule requiring crypto exchanges to collect counterparty information from transactions sent to unhosted wallets. What exactly is an unhosted wallet? Oh, so they want to control even your cold wallet. At least they gave it a fancy name, right? They called it requirements for certain transactions involving convertible virtual currency or digital assets. That's why we're here to explain that in the easiest way possible so that everyone understands what is really going on. So be prepared. And with all that said, for today's video, that's it, guys. Hope you enjoyed it. Let me know your opinions down below in the comments, and don't forget to like, share, and subscribe. And I will see you guys in the next video. Crypto Renegade